Welcome to the Beginner's Course Remastered, Lesson 4, Trends. Okay, let's start this lesson by clearing the air. Trends are levels. Wait a second, that's confusing. Didn't we talk about levels in the last video? Levels of support and resistance? Now why are you saying trends are levels? Well, trends are actually the same thing as levels. They act as areas that support and resist price, except where levels are typically drawn horizontally as a straight line, trends are drawn from point to point or diagonally. But again, the same thing as levels. They act as areas of support and resistance, and once they're broken through, they have a large reaction. Again, just like our levels of support and resistance. So now that we've talked about trends and we've defined them also as levels, let's talk about wedges. Wedges are triangles that you'll see on people's charts. They are typically used in different forms, such as pennants or bear flags or bow flags, and they have all these names that kind of really don't make sense. A wedge is simply just a trend. It has the top side of a wedge, it has the bottom side of a wedge, and these just typically form what is known as trends. You're just seeing them in a one-tool pattern that's a little over confusing to use. Why not just simply use a top trend and a bottom trend and not have to worry about this colorful wedge on your screen at all? Well, that's the purpose of this discussion about wedges, is to just open everybody's eyes to the fact that wedges are nothing but two trends used together. Now, wedges can be a great learning tool. When you're first starting to learn trading, you can start drawing wedges on your screen, and I'm okay with this. It's actually a pretty basic tool, but it communicates a very important notation, and that is that the importance of trends cannot be ignored. So whether you want to use wedges or whether you just want to use two trends to replace the top and bottom side of that wedge, just realize that no matter which one you're using, you're just simply marking trends on your charts. So now that we've defined trends and wedges, let's talk about how to actually mark these trends out. What we want to do to start is just mark the outmost bounding area of any one single trend. So what I mean by that is you want to use the base and the reach point. Those are the 2 points on your trend when you're drawing them. The base is the first point, the reach is the second point, and you're going to simply just attach the base point, again, that's the first point, to the highest wick you can find on your chart, and you're going to attach the reach point to the next wick, which is going to create the largest bounding area on your chart. So this largest bounding area can't have anything puncturing through it. We simply want to just mark the top 2 wicks, and on the bottom side of the trend, the bottom 2 wicks that go as low as possible, creating the largest bounding area possible on the chart. That is how we draw a trend. Now, don't worry, this is just the outer areas of trends, and in future lessons, we'll go deeper into the idea of trends and how they actually work, their breaching points, the multitude of different trends there are, and a bunch of advanced topics. Trust me, I have dozens of lessons on trends, and their importance doesn't stop. You'll likely go through 20, 30, maybe even 40 lessons about me rambling on about trends before you really fully understand them. But for now, we simply just want to draw the outermost bounding area as the most important trend on your chart. We're going to talk about what trends actually represent. Like we talked about earlier in this video, they are levels of support and resistance. They become targets of accumulation and distribution and also act as areas where people would buy or sell stocks. So if you are approaching a trend and maybe you bought a stock at $2, we'll use that example, and price is coming up to trend, but trend is at $4.50. Well, this area of $4.50 can act as a target for distribution. It can be a price where people are simply just getting rid of their stock. Alternatively, the level of resistance, which is trend at $4.50, may break and it might go up to $8. Just like in the last video, we discussed an $8 level of resistance breaking and going to $10. Well, our trend is the same thing. As it is also a level of resistance, it also does have a point where it breaks, and if that trend breaks, well, the level has broken and it will reach a new height. Therefore, the level of resistance just goes to the next level of resistance. This is the beautiful thing about trends. They're very simple to understand when you see them as levels, but not so easy to understand when you see them as trends. That's where most people make their biggest mistake. They think trends and levels are something completely different. They think a trend represents one idea where a level represents the other. But in all reality, trends and levels, well, they're both just levels. Levels of support and resistance. So as we just talked about a level of resistance being a trend can also be a level of support. Think about everything in reverse. If you were to instead have a trend that's holding up your trade, that trend could act as a level of support where you were to draw a trend on the bottom side of the chart, so the lowest wick candle to the next lowest wick candle, that creates the largest outward bounding box of your chart, or the largest trend or the biggest wedge whichever way you want to see it. This can also act as a level of support where you could actually buy a price and accumulate across trend. Just like you could distribute on the top side of a trend, you could accumulate on the bottom side of a trend. And both of these equally acting as levels. If your support trend breaks, guess what? You're moving down to your next support level. If your resistance trend breaks, guess what? You're moving up to your next resistance level. Again, just to repeat the same thing we just said, they're all levels. So a trend and a level is both equal as levels. So now that we have a clear idea of what trend represents and how it can create accumulation and distribution, equalized to levels, the horizontal levels and the diagonal trends that we create, we can now talk about what happens when a trend breaks. So in trades, you're typically going to get into kind of this defining moment where you have trends intersecting. You haven't really broken one side or another on these trends. You're supporting on one side and resisting on the other, but none of them are really breaking on either side. It's kind of this tug of war battle that's happening. Price keeps getting lower and lower and lower and lower, and it keeps having this bounding box that keeps compressing it inwards. This is typically where you're going to see trend on one side fail and a larger move is going to happen. So now you have to take your trends and think of them as almost a larger break, where you have support on one side being supported over time and resistance on the other side resisting over time. You'll get to this point where two trends, again, they'll intersect and one of two sides is going to break. When this happens, you are typically going to see a larger move. Think of a few different levels being broken in that same time frame, just because of the amount of tension that has been caused between these two trades and by these trends. There's a certain amount of tension that happens, and that propels a move even more. So let's think about that resistance level at 450 that we talked about briefly just a moment ago, and let's create a support level down at 250. Well, this trade bounces between 450 and 250. Maybe it goes 425, $3, $4, 325. Then it goes to 375, down to 345 to 355 to 349 to 351, and then just sits right in the middle at 350. And it has this impeding moment that's about to break. When this happens, you are typically going to see a larger move in a trade. This is the way trends work when they are forced to break. Not when a trend just breaks because, let's say it hit $4.50 and it simply broke over the level and it goes after the next one. That's kind of like a simple type of trend break. A more complex type of trend break is where it's forced into a moment and nothing has happened, but it gets to this $3.50 mark. That's where you're going to see maybe a bit of a larger move happen, up or down, whichever way the trend decides to break. Because it's forced into this moment, it has a larger reaction. So that was a very interesting discussion on trends. Most traders, even those that are extremely seasoned and professional traders, don't see trends as levels. They see them as trends, and for some reason they get them confused and they have this kind of idea that trend means something different than a level, when in reality, a trend and a level is just all support and resistance across all time frames. When traders start opening their mind to the understanding that trends are also levels and there really is no difference between a level and a trend, except where they represent a trade, they kind of go through this process where they start evolving as a trader. So it's a very interesting conversation that I like to have with traders where I ask them, what do you think a trend is? And very, very rarely do I ever just hear the simple explanation of trend is just a level, which in fact it is. So that's very, very cool that I could share that with you guys today because it's a piece of information that, again, I see in beginner traders and I see in seasoned professionals. Something both groups get wrong, something that both categories struggle with. So from this moment on, you'll never have that worry. And actually, now you're one step ahead of some seasoned professionals that I know. So that's it for today's lesson. A very simple topic, but a very unique way to look at it. Trust me, we will have dozens and dozens and dozens of lessons in the future on very advanced ways to work with trends. But for now, let's focus on the next lesson of the beginner's course, which is going to be on targets.